Did you know that the average age of financial peak is around 60 years old, according to a study by the National Bureau of Economic Research? This means the 40s can be your launching pad to financial growth. So, let's toss aside the myth that it's too late to start. In the chapters ahead, we'll uncover the secrets of wise investing, tailor-made for your 40s. From breaking down complex jargon into bite-sized wisdom, to crafting a bulletproof investment strategy, we've got you covered. And it's not just about dry facts and figures. We'll share real-life stories, nifty tools, and smart hacks that make investing not just rewarding, but also genuinely exciting. Here's a teaser. Did you know that starting to invest at 40 and continuing until retirement can still build a substantial nest egg? Or that modern technology has made it easier than ever to take control of your financial future? We'll explore all this and more. So buckle up. Whether you're a seasoned investor or a curious newbie, this guide promises to turn the seemingly daunting world of investing into an achievable and thrilling ride. Let's embark on this adventure together and navigate towards a brighter, more secure financial future. Chapter 1. The Awakening. I remember the day I turned 40. It hit me like a ton of bricks. I wasn't getting any younger, and my financial future was still a blurry picture. Is it too late for me to start investing? I wondered. But then, a quote from Warren Buffett came to mind. The best time to plant a tree was 20 years ago. The second best time is now. That was my wake-up call. You see, investing in your 40s isn't a far-fetched idea. In fact, it's a smart move. I learned that the average life expectancy in the US is around 79 years. This means at 40, you likely have nearly as many years ahead as you've lived. Plenty of time to grow your investments. One myth that often scares people away is that you need a lot of money to start investing. That's simply not true. Thanks to modern technology, investing can start with just a few dollars. Apps like Acorns or Stash make it easy and accessible for everyone. Another interesting point is about compound interest. Albert Einstein famously called it the eighth wonder of the world. He said, "He who understands it earns it, he who doesn't pays it." In your 40s, compounding can still work wonders for your investments, especially if you're planning to retire at 65 or later. So what's the first step? Understanding what you're investing in. Stocks, bonds, mutual funds. Each has its pros and cons, but don't get overwhelmed. The key is to start simple. A good place to begin is with index funds, which Warren Buffett recommends for their simplicity and effectiveness. Did you know that if you had invested $1,000 in the S&P 500 index 30 years ago, it would be worth over $10,000 today? That's the power of the stock market. And it's not just for the wealthy, it's for anyone willing to learn and take that first step. Risk is a part of investing, but it's not as scary as it sounds. It's about balance. A study by Fidelity showed that investors who stayed the course during market highs and lows generally fared better than those who tried to time the market. This is crucial in your 40s, as you have time to ride out the market's ups and downs. But how much should you invest? Here's a rule of thumb, the 50-30-20 budgeting rule. Spend 50% on needs, 30% on wants, and save or invest 20%. It's a simple strategy that can help you allocate your money wisely. Finally, remember, it's never too late to start. As the Chinese proverb goes, the best time to plant a tree was 20 years ago. The second best time is now. Your 40s are a great time to plant that financial tree. So, take a deep breath, and let's embark on this investing journey together. Your future self will thank you. Chapter 2. The Foundation. Stepping into the world of investing can feel like walking into a maze. But don't worry, it's less complicated than it seems. Let's break it down, shall we? First off, what is investing? In simple terms, it's putting your money to work for you. It's not just saving, it's growing your wealth. Think of it as planting a seed and watching it grow over time. There are different types of investments: stocks, bonds, mutual funds, and more. Stocks are like owning a piece of a company. If the company does well, so do you. Bonds, on the other hand, are more like loans. You lend money to a company or government, and they pay you back with interest. Mutual funds are a mix of different investments, managed by a professional. Here's an interesting fact. According to a report by Vanguard, over the past 30 years, the average stock market return was about 10% annually. That's way higher than a regular savings account. But remember, with higher returns come higher risks. Investing isn't a guaranteed win. The market can go up and down, That's why it's essential to understand risk tolerance. How much risk can you handle without losing sleep? Diversification is the key to managing risk. It means spreading your investments across different types of assets. Like the old saying goes, don't put all your eggs in one basket. This reduces the risk of losing everything if one investment goes south. An easy way to start diversifying is through exchange-traded funds, ETFs. They're like mutual funds but traded like stocks. ETFs give you a slice of different investments, making diversification simpler. Now let's talk about fees. Every investment has costs, like management fees or transaction fees. These can eat into your returns over time. A study by Morningstar found that lower-cost funds consistently outperformed higher-cost ones, so keep an eye on those fees. Setting goals is crucial in investing. Are you saving for retirement, a house, or your kids' education? Your goals will shape your investment strategy. For instance, if you're saving for retirement, you might lean towards long-term, lower-risk investments. How much should you invest? A good rule is to invest what you can afford to lose. Don't jeopardize your daily needs for investing. Start small if you have to. Even $50 a month can make a difference over time. Lastly, educate yourself. The more you know, the better your decisions will be. There are plenty of resources out there: books, websites, podcasts. A personal favorite is The Intelligent Investor by Benjamin Graham. It's a classic that offers timeless wisdom. Chapter 3. The Strategy. Now that we understand the basics, it's time to craft a strategy. Investing without a plan is like sailing without a compass. So, let's set our course. First, you need to define your goals. What are you investing for? Retirement, a new home, your child's education. Your goals determine your investment strategy. According to a study by Schwab, people with a written financial plan are 60% more likely to increase their investments yearly. Next up is risk tolerance. This is all about how much risk you can stomach. If the thought of losing money keeps you up at night, you might prefer safer investments like bonds. But if you're okay with some ups and downs, stocks or mutual funds might be more your style. Asset allocation is crucial. This means dividing your investments among different asset classes like stocks, bonds, and cash. A common rule of thumb is the 110 minus your age strategy. If you're 40, you'd have 70% of your portfolio in stocks and the rest in bonds and cash. Don't forget about retirement accounts. If your employer offers a 401k plan, take advantage of it, especially if they match your contributions. It's like free money. IRAs are another great option with tax benefits that can boost your savings. Another strategy is dollar cost averaging. This means investing a fixed amount regularly, regardless of market conditions. It helps reduce the impact of market volatility. Over time, it can lower the average cost of your investments. Emergency funds are a must. Before you dive into investing, ensure you have a safety net. Financial experts recommend having 3 to 6 months worth of expenses saved up. This way, you're not forced to sell your investments during a downturn. Diversification is your friend. A diverse portfolio can weather market storms better than one focused on a single sector. A report from Vanguard shows that over a 20-year period, diversified portfolios had less volatility and more consistent returns. Review and adjust your portfolio regularly. As you age, your risk tolerance and goals may change. A yearly checkup of your portfolio is a good practice. Tax implications are important too. Be aware of how your investments are taxed. For instance, long-term capital gains tax rates are generally lower than short-term rates. Knowing this can influence how and when you sell your investments. Be patient and stay the course. Investing is a marathon, not a sprint. The stock market has its ups and downs, but over the long term it has historically trended upward. Remember the saying, time in the market beats timing the market. Chapter 4. The Tools. With a solid investment plan in hand, it's time to explore the tools and resources that can make your journey smoother. Today's technology has made investing more accessible than ever before. Let's dive into how you can leverage these advancements. One of the first tools to consider is investment apps. Apps like Robinhood, Acorns, and Betterment have revolutionized investing. They make it easy to start with small amounts of money. Robinhood, for example, offers commission-free trades, which is great for beginners. Online brokerages are another fantastic resource. Platforms like Trade, Schwab, and Fidelity offer extensive research tools, educational resources, and user-friendly interfaces. They're ideal for both beginners and experienced investors. Don't underestimate the power of financial calculators. Websites like Bankrate and NerdWallet offer free calculators for everything from compound interest to retirement savings. These can help you plan and understand your potential returns. Automated investing, or robo-advisors, is a game changer. Services like Wealthfront and Betterment use algorithms to manage your investments based on your goals and risk tolerance. They're a great option if you prefer a hands-off approach. Financial podcasts and blogs are a treasure trove of information. Listening to experts and real-life stories can provide valuable insights and inspiration. The Dave Ramsey Show and the Bigger Pockets podcast are popular ones that cover a wide range of financial topics. Books can be your best mentors. Classics like Rich Dad, Poor Dad by Robert Kiyosaki and The Millionaire Next Door by Thomas J. Stanley provide timeless advice on wealth building and investing. Social media platforms are also useful for staying updated. Following financial experts on Twitter, LinkedIn, or YouTube can provide you with the latest trends and tips. Just remember to verify the credibility of the sources. Investment forums and online communities can offer support and advice. Websites like Reddit's Our Personal Finance or Bogleheads are communities where you can learn from others' experiences and ask questions. Financial planning software can help in tracking your investments. Tools like Quicken or Personal Capital give you an overview of your assets, liabilities, and net worth all in one place. Remember to diversify your sources of information. Relying on a single app or website can limit your perspective. Explore various tools and combine their insights for a well-rounded view. Cybersecurity is crucial. Ensure that any platform or tool you use has robust security measures to protect your financial data. It's wise to use strong, unique passwords and enable two-factor authentication wherever possible. Understanding taxes is vital. Some tools offer tax loss harvesting or other tax-efficient investing strategies. This can be a major advantage in reducing your tax liability over time. Chapter 5. The Challenges. Investing in your 40s can be daunting, but it's important to recognize and overcome the common challenges you may face. Here's a look at some of these hurdles and how to leap over them. First, there's the challenge of a late start. Many feel they're too late to the investing game, but remember, it's better late than never. According to a study by the National Bureau of Economic Research, even those who start investing at 40 can accumulate substantial wealth by retirement. A significant hurdle is the lack of knowledge. Many are intimidated by financial jargon and complex investment strategies. The solution? Education. Start with basic resources and gradually build up your understanding. There's no shame in starting from scratch. Debt can be a major obstacle. High-interest debts, especially credit card debts, can cripple your ability to invest. Focus on paying these off first. As Dave Ramsey says, the borrower is slave to the lender. Free yourself from this bondage to secure a better financial future. Another challenge is the fear of losing money. The stock market can be volatile, and downturns can be scary. But as Warren Buffett advises, be fearful when others are greedy, and greedy when others are fearful. In other words, don't let fear drive your investment decisions. Balancing short-term needs with long-term goals is tricky. You might be tempted to prioritize immediate wants over future financial security. A good strategy is to automate your investments. This way, you save and invest before you have a chance to spend. Underestimating retirement needs is common. Many don't realize how much they'll need to maintain their lifestyle in retirement. Use retirement calculators to estimate your needs and adjust your savings plan accordingly. Market timing is a frequent mistake. Trying to buy low and sell high often results in missing the best market days. A study by JP Morgan Asset Management showed that missing the top 10 trading days every decade can significantly reduce investment returns. Inflation is a silent challenge. It erodes the value of your money over time. Investments, particularly stocks, can be a hedge against inflation. They tend to offer returns that outpace inflation over the long term. The temptation to follow trends or hot tips can lead to poor investment decisions. It's essential to stick to your plan and avoid chasing the next big thing. As Benjamin Graham, the father of value investing, said, "The investor's chief problem, and even his worst enemy, is likely to be himself." Healthcare costs in retirement are often underestimated. Fidelity estimates that an average retired couple will need about $295,000 for healthcare expenses. Factor this into your retirement planning. Chapter 6. The Future. As we approach the final chapter of our investment journey, it's time to look forward with optimism and a clear strategy. Investing in your 40s isn't just about the present, it's about securing a bright future. First and foremost, envision your retirement. What does it look like? Are you traveling, enjoying hobbies, or simply relaxing? Having a clear picture in mind can be a powerful motivator. According to a study by TD Ameritrade, those who visualize their retirement have double the savings of those who don't. Long-term thinking is key. Investments, especially in the stock market, perform best over extended periods. The S&P 500, for instance, has historically provided average annual returns of around 10% over long periods. This means your investments have the potential to grow significantly over time. Revisit and adjust your plan regularly. Life changes, and so should your investment strategy. A yearly review is a good habit, allowing you to adjust for changes in income, family circumstances, or financial goals. Estate planning is an often overlooked aspect. Ensure you have a will and other necessary legal documents in place. This ensures that your assets are distributed according to your wishes and provides peace of mind for you and your loved ones. Health is wealth. Investing in your health is just as important as investing your money. After all, what's the point of a robust investment portfolio if you're not healthy enough to enjoy it? Remember, healthcare costs in retirement can be significant. Stay informed about Social Security benefits. Understanding how and when to claim Social Security can greatly impact your retirement income. According to the Social Security Administration, the average monthly benefit was about $1,500 in 2021. Knowing your benefits can help you plan better. Diversification remains crucial as you age. As retirement approaches, consider shifting towards more conservative investments to protect your nest egg. This doesn't mean avoiding stocks entirely, but rather finding the right balance for your age and risk tolerance. Consider alternative income streams. Passive income sources, such as rental properties or dividends from stocks, can provide extra financial security in retirement. Inflation continues to be a factor. Your retirement savings need to outpace inflation to maintain your purchasing power. Keep this in mind when planning your investment strategy. Don't underestimate the power of compound interest. As Warren Buffett says, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Even small investments can grow significantly over time. Teach your children about investing. Passing on financial knowledge can be one of the most valuable legacies you leave. It sets up future generations for financial success. Finally, remember that it's never too late to start. Whether you began investing in your 20s, 40s, or even later, every step you take is a step towards a more secure financial future.